so let's have a conversation now, I guess, about North Asia versus South Asia. Of course, when you look at some of those developed markets like the yen, we were having a conversation about the BOJ a little bit earlier on. But what's your preference right now if you're allocating to these fixed income, to these currency markets? Which side of the equation do you prefer?
Yeah, it's an interesting question. If you were to ask me what's your view on the dollar, I say the dollar's going down this year, and we like EM currencies in general. If you were to ask me to get more specific, I'd say we have a preference for the currencies of Southeast Asia, like Indonesia and Malaysia, India and Thailand to a lesser degree, over the currencies of North Asia. The reason for that is largely the yield story that we were talking about earlier, right? The currencies of ASEAN still offer very attractive yields through their currencies, and we think that will remain a compelling driver of capital flows. Now, in an environment where all of EM is doing well, that's less important. But in an environment where you perhaps get some consolidation or even a retracement in things like equities or economic sentiment, then that yield buffer becomes really important. And so for that reason, we like South Asia over North Asia.
Is that all predicated, though, on the Fed doing absolutely nothing over 2020?
It is predicated on central banks generally being very quiet. Okay? 2019 was the year of the bond, and part of the reason for that was that central banks around the world, DM and EM, were cutting interest rates fairly aggressively. In 2020, we still think there are a few central banks in EM that will cut, but the Fed is expected to largely be on hold. And as long as central banks are sitting mostly on the sidelines, that tends to be a net positive for EM.
Okay, Dan has a question.
Eric, one of the questions that I asked our guest in the last hour related to the economic outlook and the stabilization that you've been talking about. Do you think that perhaps a more hawkish Fed could be a key risk for equities, EM assets in the second half of the year, given the improving situation that we see in the United States and perhaps fears of a recession or a full-blown trade war being put to one side now?
I would certainly agree with you that if the Fed were to get hawkish, or any of the central banks for that matter, were to turn materially more hawkish in the second half, that would be destabilizing for markets. We have a slightly different outlook, which is in an environment of central banks being on hold, we think the risk is that they may have to ease again and sooner. And the reason for that is 2020 for us is a year of stability, but 2021 is a year of renewed downward pressure on global growth. And the reason for that is the more structural factors like demographics, the enormous debt overhang which exists out there, deglobalization is another factor. And so we still expect economic growth globally to slow next year. I think the risk is that that slowdown starts to materialize in the second half. So I think the risk is the Fed going to a more dovish stance rather than a more hawkish stance.
Okay, so what are the signals or the signs or the metrics that investors need to be looking out for as we progress throughout the course of this year that will help them to understand where we're at in the cycle, particularly in the United States, where people are saying this is what peak US looks like right now?
Yeah, that's a fascinating point. The single biggest factor that we're paying attention to in the US is consumer spending and the labor market. And the reason we say that is even with the slowdown in earnings that we've seen, the U.S. equity market's been very resilient, and the labor market has been extremely stable at very strong levels. And as long as people have jobs, they will spend. Now, the strength of the dollar over the last 8 years and a number of other global factors, we believe, will continue to exert some downward pressure on corporate earnings. In other words, that legacy of dollar strength from the past 8 years. If corporations really start to feel the bite in terms of margin pressure and they do start to reduce headcount and hiring, then that weakness should filter through to consumer spending. Now, that's not a baseline view, but I think that's the single most important guidepost for investors to be paying attention to.